Hello, and welcome to the Logistics Management Podcast. My name's Jeff Berman. I'm Group News Editor for Logistics Management Magazine and also the Peerless Media Supply Chain Group. Today, it's a real pleasure to welcome back Ben Gordon to our podcast. Ben is founder of BGSA and also Cambridge Capital, located down in Palm Beach, Florida. Ben draws on a career spent investing in, advising, and building supply chain and technology companies. At BGSA Holdings, he led the firm's efforts, advising on more than $1 billion worth of supply chain transactions. He's worked with such firms as UPS, DHL, Kuehne Nagel, Agility Logistics, NFI Logistics, GENCO, Nations Express, Raytrans, Echo Global Logistics, Dixie, Wilpak, among many others. Prior to BGSA Holdings, Ben founded 3Plex, the internet solution enabling third-party logistics companies to automate their business. He also raised $28 million from blue chip investors, including Morgan Stanley, Goldman Sachs, Bank Boston Ventures, CNF, and Ionian. 3Plex was then purchased by Maersk. Prior to 3Plex, Ben advised transportation and logistics clients at Mercer Management Consulting, and prior to Mercer, he worked in his family's transportation business, AMI, where he helped the company expand its logistics operations. Ben holds an MBA from Harvard Business School and a Bachelor of Arts from Yale College. Hey, Ben, welcome back to the podcast.
Jeff, great to be with you again. Thank you.
Absolutely. So, Ben, for those listening in that may not be familiar with your businesses, can you just give us a real quick overview of both BGSA and also Cambridge Capital?
Sure, pleasure to. So, Jeff, BGSA is our investment bank. We've done over 50 M&A transactions in the supply chain world over the last 25 years, and Cambridge Capital is our private equity firm. We've been an investor in several terrific companies over the last 15 years, including XPO as it grew from an idea to a $20 billion business, Green
Right.
Screens, which we just sold last year to Triumph, and a host of others. So,
Oh,
really, we have an advisory side and an investing side all focused on the logistics and supply chain arena.
that's terrific. Thanks for that overview. So, Ben, let's just jump right into it. How would you sort of assess the state of M&A within freight transportation, supply chain, and logistics as you're looking around for deals and kind of seeing what's cooking, if you will?
Well, the M&A market is robust, and it's robust for a couple of reasons. One, I think the traditional supply chain services companies are all looking for growth. The public companies, of course, want to be able to demonstrate growth. So do the private equity-backed companies, many of whom have been in extended hold periods. If you were a private equity or venture firm and you invested during COVID, 2020, 21, or 22, those were boom years, and then we've had the great freight recession and other challenges over the last 4 years, and that's delayed people's exits. But now, as markets are coming back, people are starting to explore those options. And so I think in the services world, you've got this, on the one hand, desire on the part of buyers to achieve growth, and on the other hand, desire on the part of sellers to sell into a recovering market, which is where we are today, as opposed to, say, 2, 3 years ago. Then on the supply chain software side, you have something different going on. It's quite interesting. On the one hand, there are high growth software companies that are doing great and have the opportunity to sell off the back of high growth and success. Green Screens was a good example of that. On the other hand, you have this, what they're calling the SaaS apocalypse, where software companies have been hammered in the public market. So, 30, 40% decline in market value over the last 6 months for many major
Mhm.
companies, whether that's giants like SAP and Oracle, or more supply chain specific companies. Um, and that is, on the one hand, likely an overreaction to the fear that ChatGPT and Claude and other AI is going to eliminate software. That's not going to happen.
Hmm.
But on the other hand, it is likely that it's going to change how the software world works, and the winners will be those that can adapt. And so, there's an interest on the part of traditional software companies to buy AI forward companies to accelerate that trajectory. There's an interest on the part of AI companies to buy traditional software companies so they could gain an installed base and then push their technology out to that base. And so there's a very interesting convergence of traditional and AI. So I think those are kind of the two big things that we're seeing on the services side and on the software side.
Okay, great. And then, I guess it's kind of a two-part question here, Ben. I was kind of interested in exploring kind of maybe a continuation of what you were telling me as we look at the main trends and themes in the deal making space. And I guess we can look at it from a logistics perspective. For example, Echo Global Logistics yesterday just finalized their deal to acquire ITS Logistics. That deal got a bit of attention when it was first announced as a good example. But what verticals, what sectors are you seeing the most activity within at the moment, or is it sort of a mixed bag, so to speak?
I think we're seeing activity in several areas. So one is traditional supply chain services companies expanding. The Echo transaction's a great example. Um, Two is software companies that are expanding the scope of what they can do. I I'm days away from being able to announce something that think will be pretty interesting that involves a large public supply chain software company that's making a move to expand their scope of capabilities, and that'll be public likely next week.
Okay, terrific.
I hate to be a tease, but that's coming. And then I think, look, third, there's the AI fueled appetite. AI companies buying traditional and traditional companies buying AI. But I think those are three areas of M&A activity where we're seeing a lot of interest.
Absolutely. What about deal activity on the e-commerce logistics slash last mile side? Do you still see them happening at a high level, or has there been any type of a shift to other segments like freight brokerage, tech slash automation, warehousing? I'll throw robotics in there as well.
Yeah. So a little bit of everything. I'll highlight where I think there's
Yeah,
the
no,
most.
whatever you want to hit on is fine with me.
You got it. So
Yeah.
Jeff, I think one thing that we're seeing is there are consolidators. So in the last mile arena, there are companies that are trying to stitch together regional capabilities to create something national. And as an example, well, there are some transactions pending that I won't name, but there are. You think about the realm of last mile. Um, there's no huge giant that dominates. Nobody has more than 10% market share on last mile in
Sure.
aggregate. So you have companies, let's say large public companies that have a last mile offering. Transforce has a last mile offering. FedEx just announced a partnership to expand in that realm, but it's early days. There are private equity backed companies, private companies like USPAC, but by and large, and then XPO, which made acquisitions in earlier days like 3PD, um, uh, well, the original Express One platform,
Hmm.
Urban Express, and others. So what's happened is there are now lots of other smaller companies that are saying, "Hey, I see an opportunity to scale up." We have portfolio company Delivery Circle that's one of the contenders in that realm. We have a software company called Bring that's a SaaS last mile orchestration company that powers many companies in last mile as well as retailers, brands, and logistics companies as they seek to grow in that realm. So I think that's last mile is one interesting area. Another interesting area is e-commerce fulfillment. And so you have some traditional consolidators. One example, over the last decade plus, Radial made a string of acquisitions.
Hmm.
Another, of course, GXO has been very successful, and PFS Web, Clipper, and other acquisitions that they've made. Third, you can look at some of the challengers that are emerging, like Cart.com, which has made over a dozen acquisitions in and around e-com fulfillment over the last 5 years. So there's lots of expansion around that. Then you have what I would call the broader world of e-commerce supply chain. And if you think about it, you've got four critical areas. There's the fulfillment part, which we've discussed, last mile, which we've discussed. There's also returns, and then there's post-purchase tracking and visibility. All four of those are an important part of the ecosystem. And so where have we
Hmm.
seen activity? Well, in returns, we saw Optoro sell to Blue Yonder. And I think there's a lot more opportunity there. We at Cambridge have a portfolio company, Reverse Logic, that's doing great, and that certainly a very relevant leader and piece of that equation.
Okay.
In the realm of post-purchase, you want to know where's my stuff, so that tracking and visibility arena, which is very important. We have a company, Parcel Perform, that specializes in that, powers tracking and visibility for e-commerce marketplaces, brands, and others. And I think there's an opportunity for somebody to look at consolidating those different elements and create a complete e-commerce supply chain platform. In other words, I think what XPO did from 2011 to 2016, where Brad Jacobs led a string of acquisitions to create a consolidator in supply chain services, is a blueprint for somebody to follow on the digital side for e-commerce supply chain. And I think that's something that we are likely to see in the next 12 months.
Okay, great, great. And just circling back to AI for a moment, Ben, can you shed a little bit more light in terms of how companies are using it to create value? C.H. Robinson obviously comes to mind. We've written a lot about them here at Logistics Management in terms of the inroads they're making in AI, and also perhaps who the emerging winners are among others too.
Absolutely. Well, let me start with your first question. So, successful companies that are using AI. It's a great topic because, on the one hand, you have a lot of hype. There's a lot of storytelling around AI,
Yeah.
and so it's sometimes hard to separate the hype from the reality. But C.H. Robinson's a great example of someone that's really creating value. So, what happened? Well, in the last 4 years, Jeff, as you know, and as your listeners and readers know, we've lived through the worst U.S. freight recession in American history. So, freight rates dropped an average of 50%, record bankruptcies, all kinds of dislocation. And that recession continued last year. Despite that, somehow C.H. Robinson managed to grow revenue, profit, and their stock price, which shot up 56%. So, obvious question, how did they do it? Well, it turns out that AI was a big part of the story. They launched 30 AI agents. One example was an agent that went through their entire email system and they said, look, turns out we have a problem. They said 60% of the orders that come in, requests for quotes, get a response, 40% don't. That's a staggering number, right? That means 40% of the time, you're not even in the game. You're not even making a pitch to win the business that customers are asking you for. And then when they do respond, the average response time is over 20 minutes. Well, if you're a customer looking for a transaction, are you really going to wait 20 minutes? Probably not. So the goal of one of their agents was drive the response time scope from 60% to 100, and then cut the response time from 20 minutes to 20 seconds. They succeeded in doing both of those things. And
Yeah.
so as a result, they were able to bid on more opportunities and win more opportunities and do so uh, much more profitably. And so that really explains why their margins went up at a time when so many others' margins went down. So it's a pretty good case study for how you can use AI to create value in the traditional world of logistics and supply chain.
Sure, no question about it. And it only stands to reason we're going to see more uh, accomplishments like this going forward by other companies of all sizes, really. So, Ben, when we first met more than 20 years ago, when I first started covering this space, I saw you speak. Maybe it was at CSCMP or I for Transport back when they still had conferences. I can't recall. But one thing that you said that stuck with me when, especially as it relates to the M&A sector within freight transport, supply chain, logistics, was that of service convergence, where two companies kind of come together within an acquisition. Maybe the company that's making the purchase is buying someone because they have something that the buyer needs. The service convergence, in your opinion, remain alive and well within the logistics M&A space?
Well, absolutely. One example would be the Echo acquisition that you just alluded to,
Okay.
which is really about combining truck brokerage with warehousing and contract logistics capabilities. Another example would be moves that NFI, a great example. NFI, which, taking a step back, 25 years ago, NFI was mostly a trucking company. $100 million revenue business,
Mm-hmm.
mostly truck line, some warehousing, and some brokerage and some dedicated. Uh, Aggressive pursuit of this service convergence over time. And so, and they've built out through acquisitions, including over the last few years, Cal Cartage that takes them into the drayage and port-based logistics, moves in other value-added services, intermodal, freight forwarding. So putting together a broader and broader bundle of capabilities. So I think that's certainly another illustration. I think a third would be, and you're going to see more of this, I believe, in the coming year, companies that are in truck brokerage that are moving into freight forwarding and intermodal and drayage. Partly that's
Mm-hmm.
because there's growth and adjacency, but also partly it's because brokerage has been a hard market and putting bigger bundles together creates more value. And so that's something that you will see more and more of. Um,
Okay.
another convergence opportunity that we see, well, it was kind of the last mile conversation that you and I were addressing earlier. Companies
Mm-hmm.
that are in LTL move into last mile because they're adjacent, right? If I'm saying to a customer, I could deliver something within a 500-mile radius, which might be an LTL shipment, regional LTL, well, why not that density of last mile, say last 50 miles that tends to go hand in hand. That's the reason why historically LTL carriers have been interested in buying last mile companies because it gives them that kind of convergence. So, um, and the last thing that I'll add is you're also seeing convergence of software and services. And what I mean by that is traditional supply chain services companies buying software companies that give them a competitive advantage or growth, and vice versa. So, for instance, Stored, which really it started out as a software company and a tech-enabled e-com fulfillment company, has made acquisitions of some more traditional e-com fulfillment companies.
Right.
And that gives them a broader mix from a business standpoint. It allows them to buy good, well-run businesses that could also benefit from the superior productivity that great technology can bring them. And in the end, it should translate over time into more growth, more margin, and more differentiation. So I think those are all kinds of convergence that we're seeing.
Okay, terrific. So looking at the global trade environment, Ben, I mean, it honestly could be viewed as uneven. Definitely an understatement when you look at tariffs, shifting trade policies, things like that. But with that as a backdrop, does the uneven global trade environment, in your opinion, create opportunities or challenges from a deal-making perspective?
I think it certainly produces opportunity. I mean, so where are there some examples? Well, number one, the volatility in global trade. We just had discussions about this among the 400 plus CEOs at our annual conference in January here in Palm Beach at the Breakers, and CEOs of companies like Siva, DP World for the Americas, and others were discussing this very issue, Seco and
Sure.
BGSA, et cetera. And a couple of takeaways, Jeff, on this topic. One, volatility is a challenge for customers, but it's an opportunity for logistics companies. So if you're a freight forwarder and you can help your customers manage that volatility, great. You're creating value for them, and there's margin opportunity for you. So I think that's certainly one. Um, Secondly, I think it's worth noting that um, if you have, as we expect, declines in China to US volume, that translates to increases in, let's say, uh, Vietnam or Singapore or other Asian markets into the US. That
Mm-hmm.
also produces a catalyst for growth in cross-border like US Mexico. And it also contributes to growth from Europe to US, where we're seeing signs of early port congestion on the East Coast. So those produce opportunity in several ways. One, that means that you can look as a freight forwarder at ways to get in front of those trends. Two, it means from an acquisition standpoint, there's more interest in companies that specialize in those categories that are producing growth, whether that's U.S. Mexico or East Coast ports or trade between U.S. and other markets that stand to gain as the U.S. China trade is reduced, and in turn other markets increase. And then third, uh, it is also an opportunity for software companies that can do a great job of helping global freight forwarders, whether that's with calculations of customs and regulatory compliance and things like that, or for that matter, other kinds of software that help freight forwarding companies automate more. So I think those are all some of the ripple effects and opportunities from trade volatility.
Okay, great, great. Two more quick ones, Ben. Do you see any material impact from the ongoing Iran conflict on deal making?
Um, Not really. I mean, look, I think if we're in the same position a year from now, different story. But the reality is, look, I think there's been a lot of noise about oil prices. Guess what? Oil prices are still lower than they were in 2022. And they're still lower than they were when Russia invaded Ukraine. So
Hmm.
I think while you might prefer lower prices to higher prices, for consumers, for transportation companies, and for everybody other than oil producers, the reality is, number one, we're still lower than where we were 3.5, 4 years ago. Number two, taking a step back, oil as a percent of GDP is much lower. If you compare this to say 1973 and the OPEC oil crisis, oil as a percent of consumer spend
Hmm.
is less than half of what it was then. So look, it's one of those things that appears in the news because if it bleeds, it leads, right? But
Right,
but
right,
uh, but I don't think it's as big a deal as you might think if all you did was rely on the New York Times headlines. I
right.
also think that it in some respects accelerates a trend that we've been seeing over the last uh, several years anyhow, which is the growth in the domestic supply chains. Because reality is, um, if you thought that oil prices were going to spike higher, the place that would have the biggest impact would likely be on air shipments, where fuel's a bigger percentage of aviation. And guess what? That would be one more catalyst for companies to invest in building domestic supply chains. So, while I think the oil story is overblown, I do think the bigger underlying trend is lots of reasons for companies to be more focused on growing in domestic U.S. supply chains, whether that's manufacturing or distribution, and that, of course,
Mhm.
translates into warehousing and transportation. Does it have
Yeah,
some adverse effect on trucking because the fuel cost? Sure, but again, smaller than the impact that it would be on aviation, and of course also muted by the fact that there are other modes, including rail and for that matter, increasing growth and adoption in electric, which is a small percentage today, but with very high growth rates. So, but bottom line is, to answer your question directly, no, I'm not seeing a a strong linkage between the war in Iran and anything of lasting substance on the U.S. M&A markets.
okay. All right, great, great. And last question here, Ben. What does the landscape for logistics, supply chain, freight transport related deals look over, say, the next 3 to 5 years?
Well, I think the landscape is this is a time where we are still looking at large, growing, fragmented markets that are ripe for M&A. When Brad Jacobs looked at this market, Brad came to our conference in 2010, and we had a conversation about where would he go. He had built four companies from nothing to over 1 billion, and was looking for his next industry, and settled on logistics because it was large, growing, and fragmented. And of course,
Hmm.
the rest is history. But guess what? Those attributes today are still there, right? They're still there. Are they as juicy as they were in 2010? Well, there's less fragmentation, right? Brad Jacobs and other consolidators have seen to that. But still, truck brokerage back then, top 50 companies might have been 20% of the market. Today, maybe they're
Hmm.
50% of the market. Compare
Yeah.
that to other industries, right? Like in the world of financial services, where I think the top six banks are something like 80% market share, starting with JP Morgan. So, but by contrast, logistics is still very fragmented. And that's not just true in truck brokerage, it's true in warehousing and freight forwarding and in all kinds of other supply chain services and supply chain software categories. So I think lots of room for opportunity, lots of consolidation and lots of M&A. And I think that's combined with the fact that in a global world, the supply chains globalize, and that means that you have overseas buyers looking for U.S. platforms. Companies like ID Logistics, which bought Kuehne Logistics in the U.S., coming from France into the U.S., or for that matter, coming back to fulfillment. The Groupe Staci from France that bought Amware and then in turn sold to Radial, but continue to do more. So I think you're going to see more and more cross-border activity as well. And then third, all the activity on the software side, I think we're very much in the early innings. You might say supply chain software from an M&A standpoint looks like where supply chain services was, 25 years ago. So I think we're going
Okay.
to see a lot of activity.
All right. Terrific. All right, Ben. Well, this has been great. On behalf of Logistics Management Magazine and the Peerless Media Supply Chain Group, I'd like to offer up a big thanks for joining us again today, which, if I'm not mistaken, I believe today marks the fourth time you've joined us for a podcast. Thanks very much for coming back.
Well, my pleasure. Thank you. Always a pleasure to talk with you. You have great questions, great insights, and look forward to the next time.
Most appreciated. And for those of you listening in, please feel free to check Ben out and connect with him on LinkedIn, linkedin.com/IN uh, backslash that is Ben Gordon 18 and followed by one more backslash. And for those of you that are not subscribed to the Logistics Management Podcast, wherever you get your podcast, just go ahead and punch in the Logistics Management Podcast and it will come right up. Thanks, everybody, and have a great day, and we'll talk to you real soon.
Great.